Everyone, thank you so much for joining us. We're really excited to talk to you about how to prepare for your IPO. It's a big undertaking and there are a lot of considerations, so we're excited to tackle them. There are a lot of people from various jurisdictions on this call, so we also have presenters from various jurisdictions. So our goal here is to really talk about the high level common themes that you're going to encounter in any jurisdiction rather than get bogged down in the technicalities. So again, my formal introduction, Farrell Keel. I'm a partner in our Dallas office in financial markets, and I'll pass the baton to the rest of my colleagues to introduce themselves. So Pete.
Hi, it's nice to be with everyone. My name is Pete Devlin. I'm a capital markets partner in Jones Day's New York office, working across the capital markets, but in particular, I've spent a good bit of time in recent years working with life sciences companies, both US and non-US based, going through the US public offering process. So looking forward to speaking with you.
On to Vika.
Hi everyone, my name's Vika Irani. I'm based in London, focusing on IPOs and also secondary equity offerings as well. Good to be here.
To all, Renaud Bonnet from the Paris office. I've been a partner at Jones Day for the past 20 years with a focus on tech and life sciences, including multiple IPOs in France and in the US.
Last but not least, Charles.
Everyone, I'm Charles Chow from Hong Kong. I'm also a capital markets partner. I have worked with a lot of life sciences company, both in China and outside China.
Great. And so with that, I think we're kicking it over to Pete.
Great. Thanks, Farrell. And so, because the IPO market maybe today stands in such a sharp contrast to the market last year, I thought perhaps it's helpful to sort of start by talking a little bit about where the IPO market is. And maybe, in the first instance, by doing so kind of in reference to 2021. So as you may know, 2021 was a record year with remarkable IPO activity and a lot of that at remarkable valuations. This momentum was, it was bolstered in part by the boom in the SPAC market, but the traditional IPO market was also extraordinary last year. And so the momentum of the market and the risk appetite that came with it also meant that the IPO market was open to very early stage companies. So in the life sciences, primarily like in the biotech space, we saw a large number of IPOs by preclinical companies or companies that were clinical stage but had very early data available. With 2022, we've really seen a confluence of headwinds that have sort of wreaked havoc in the markets and have led to a dramatic pullback. The volatility that's accompanied this combination of kind of inflation, increasing interest rates, geopolitical tensions, including Russia's invasion of the Ukraine, all of these have led to significant flights away from risk. And so one of the effects of this pullback has been, a significant drop in valuations. And the vast majority of those 2021 IPO companies, I'd say are now trading well below their IPO price. And so as you can imagine, that sort of has had a significant impact on companies thinking about doing an IPO this year. And just to kind of give you some quantification of that pullback in the US market, at least, if you look at just companies with a market cap over $50 million, you see sort of a year-over-year decline of over 80% by number of IPOs and by 93% year-over-year by proceeds raised. So, there have been a couple of green shoots, including recently in the form of companies going to the market on the heels of kind of compelling data. But at present, I think, what we're seeing is that most companies that were contemplating an IPO have really written off the balance of 2022 and are kind of taking a perspective of let's see what 2023 brings us. And so, Vic, I don't know if you've seen something different in London, but would be interested in hearing.
Look, London's been exactly the same. I think it's unlikely that we will see significant, if any, meaningful IPO activity this year. We are aware of a number of companies preparing in the hopes that 2023 presents a more stable environment and one which is more kind of conducive to IPO activity. So I think what we're seeing at the moment are kind of IPO plans being put on hold, certainly for the rest of this year, but in the contemplation that, you know, preparations may be ongoing for those companies hoping to make it this year, so that they can take advantage of the window if it sort of opens in 2023. So I think, you know, 2023 will be an interesting year to see whether we do get that kind of return of at least some form of stability in a more benign environment. And if we do, I think we can expect to see IPO activity pick up again.
And Renaud, anything different sort of from a broader European perspective in France?
Very much similar to the US and the rest of Europe. The drop has been spectacular in France since the beginning of the year versus 21. I believe only 7 IPOs were completed on the main French market since the beginning of the year, plus 27 or so on Euronext Growth, mainly in green tech and tech, and to a lesser extent in biotech and pharma. There are many projects in the pipe, but the French IPO market has very much come to a halt, and it is not anticipated that it will resume before next year, which can easily be explained by the energy crisis, the war in Ukraine, and generally the very uncertain economic and political context.
Okay. And Charles, with sort of maybe some of the return of Chinese companies to China, has China kind of bucked the trend at all?
Unfortunately, the market in Hong Kong is almost the same as our counterparts in US and in Europe. For Chinese company, because of this lockdown policy for the COVID earlier this year, a lot of Chinese companies' business have been seriously affected by that. So coupled with the increasing political tension between China and the Western world, I think the prospect of having a better capital market, at least for this year and the first half of 2023, we are not seeing a significant upturn.
Got it. So Farrell, do you want to maybe then round things out with kind of what you think maybe is coming down the pipe when the window opens?
Of course, I wish I had a crystal ball. That would be wonderful. But yeah, so I think it'll be interesting. It's going to be, I think, you know, well, looking actually what happened yesterday with Mobilize IPO pricing yesterday, I think people are going to be looking at kind of those specific, you know, IPOs that are going to be a little bit bold and see how they do as kind of these test cases. We've all pretty much agreed that 2022 is out, but that will perhaps start happening in 2023 where we'll see people testing the market and seeing how they end up trading. And if they flop, then it's going to kind of, you know, extend the lull. But if they do well, you know, it's going to potentially open up that those windows. And so I think the first companies that are going to be going out are going to be the ones who actually have, you know, the revenue. So that can be a little bit difficult for the preclinical companies who are still, you know, in the process of creating their products for market. So yeah, I again wish I had a crystal ball, but I think it will certainly be an interesting year. And with that, I think we're now going to talk about some timing and readiness. Renaud, can you walk us through this?
Sure, I would gladly do that. So as we have just seen, critical to the timing of any IPO are the market conditions, which depend on a combination of economic and political factors well beyond any issuer's control. It is therefore of the essence to be prepared to changing or unexpected market conditions or circumstances. And the best way to handle this is to engage sooner than later in preparing for the IPO. This in order to be able to seize the market windows as soon as they materialize. Vice versa, the company, you know, any IPO candidate should anticipate the timing may slip and make sure that it will have enough cash to continue to operate in case something goes wrong, which may involve considering, aside from the IPO, multi-track alternatives such as a crossover private round of financing and or M&A options. And with that, I will pass it on to
Charles for talking about the advantages of an IPO.
Yeah, there are obvious advantages of doing an IPO. First of all, it is a means to raise fund by company. So that would pave the way for you to access to new capital. At the same time, because your company's shares are now publicly traded, any shareholder can buy and sell the shares. So that will provide liquidity, in particular to the to the founder that you may wish to sell some shares and then get some money. Of course, a listing status will enhance the profile and visibility of your company. And then after that, because your profile is enhanced, so you will attract more talents to join the company. And at the same time, since your shares are now publicly trading, you can give some shares and share options to the employee. That would be another means to attract the good talents to join the company. One last point, last but not least, doing an IPO, making your company shares publicly traded, you can use it as a means to do M&A. That is to say, in the past, if you want to acquire a new company or acquire a new business, you would need to use cash to pay the seller. But for a public company, you instead of giving cash, you can issue new shares to the target. You issue new shares to the seller, so that would enhance your M&A opportunities.
Great. And then so, again, we have people from all different jurisdictions here. And so it can be a difficult choice up front of how do you even pick where you're going to IPO, whether it's a single market or a dual listing. And so I'd love to ask everyone kind of what are your thoughts on how you pick that? Maybe kicking it off with Pete for NYSE NASDAQ listings.
Sure, Farrell. And so, I mean, for companies considering an IPO, I think including non-US companies that are exploring their options, I think there's really two key factors that draw them to the US markets. I think first, as Charles kind of mentioned with listings more generally, I think there's an element of what we can think of as kind of reputational capital that comes with a US listing. So companies that are able to navigate the US IPO process and comply with kind of the stringent regulatory and listing requirements in the US, gain a degree of prestige that I think brings with it access to a broad network of investors. I mean, ultimately, though, I think, really the key driver in terms of the draw of the US capital markets is really just the depth and the breadth of these markets. I mean, companies that list on the US exchanges essentially gain access to the deepest, most liquid market in the world. And it's hard to overstate the importance of that for a life sciences industry that is so capital intensive to be able to tap into the US markets.
Renaud, what are your thoughts on Euronext?
Well, I can only concur that the opportunities to raise capital in the US are in fact unparalleled. However, not all companies, particularly non-US companies, are fit for NASDAQ or NYSE. And some companies are too small to handle the complexity, the costs, and the potential liabilities associated with achieving and maintaining a US listing. And also, even if they have the degree of sophistication required, they may not attract any meaningful attention by US standards once listed there, if only because they will be lost in a large crowd of much larger companies, whereas they could stand as champions on their local market. So typically, I would recommend against a US listing for any company whose value is not at least and pre-money value is not at least $250 million. Also, speaking for Europe, Euronext is a natural choice for companies that are incorporated in continental Europe and have a strong local business as opposed to a global reach. A dual listing in the US can be achieved at a later point, as several of our clients have done in recent years. This would qualify as a two-step US listing, starting with a European listing and moving on to US listing, dual listing in the US, if and when successful enough on the markets. Also, I should stress that during the COVID crisis, accessing to zero interest loans from the government was very much facilitated in France for companies listed here. Likewise, the European Investment Bank is a natural partner to any European listed company. So any company, contemplating an IPO should carefully assess the potential adverse consequences of opting for a foreign market rather than a local one. Moving on to Vika, I believe.
Hi there. And so, I mean, look, for London, the considerations are similar to what Renaud's just articulated for Europe, in the sense of there are companies who ultimately might plan a US listing when they reach significant size and scale, but start off in London to give them higher profile, greater interest from analysts and investors, and greater access to capital. I think the capital markets in London still provide an incredible depth and scale of investment and are a terrific pool of available capital. I think London is also an incredibly international market. And so for non-UK companies looking to list in a sort of sophisticated and established market with access to a significant pool of investors, London is often a natural choice because the investor base in London is very used to non-UK issuers and is very used to assessing them and taking on that sort of profile. London has a number of different options for listing. We've got our growth market, which is often the first stepping stone, and then the main market, which offers both a premium and a standard listing. Standard obviously provides more flexibility, but less profile and cachet than a premium listing. And any of these can be used in conjunction with a US offering as well. And so we often see companies come to London for access to capital, yes, but also at a time when they perhaps wouldn't, to Renault's point, get the same level of attention in the US just because they're not quite of that size yet. So I think we're moving to Hong Kong.
Yes.
Hong Kong is also an international financial center. So listing in Hong Kong would surely attract money from all investors from all over the world. But there's one unique advantage, cutting edge for Hong Kong market is that would be the way to attract Chinese investors. There's a special arrangement between mainland China and Hong Kong that company with a valuation of more than 750 million US will be put on the list of the Stock Connect. Chinese investors are allowed to invest only on company listed on the Stock Connect. So I think that would be one of the special characteristics for the Hong Kong market.
And with that, we're going to head back to Pete, who's going to talk about how do you evaluate whether or not you're ready.
Yep. Thanks, Farrell. So one of the things, most companies that are thinking about an IPO are really doing so because they've been successful as a private company. But in light of the challenges that come with operating as a public company, it's really important that companies that are thinking about, pursuing an IPO are also well prepared, both in terms of the resources that are involved, as well as kind of fully understanding what winds up being the most effective with potential IPO investors. And I think an important part of IPO readiness that you sometimes hear kind of spoken about in a little bit of cliche is this notion of establishing an equity story. And really what where people are talking about when they're talking about your equity story is this presentation of the company that's compelling to investors, that kind of clearly articulates the company's business model, its competitive advantages, and that does it in a way that establishes confidence around management's ability to execute on the business plan. And I think within the life sciences industry in particular, a key component of this equity story really ties to the pipeline and the pipeline prioritization. That a company that's pursuing an IPO is realistically sequencing their key milestones and demonstrating a realistic path for managing the cash that is available towards the next value inflection point. And so in this regard, I think an important part of the IPO readiness for a life sciences company is giving a hard and critical look at their anticipated timelines to sort of ensure that the milestones that they're presenting to investors are kind of presented in a way that contributes to their long-term credibility. And I think this is always a little bit of a push and pull in that, companies want to, present an exciting path forward, and it does create a little bit of risk that, if you wind up over promising in terms of, when you're going to be able to deliver on critical milestones, you can sort of hurt your credibility in the longer term with investors. So a lot of work, I think, goes into thinking about what's the right milestones to present and the path to getting to them. I think on the last 2 points here, I think the common theme is really around understanding and building out the resources that are necessary to operate as a public company. And I mean this both at the management level as well as throughout the organization. So, companies want to evaluate whether they have the expertise to operate the core business of product development and innovation, but also at the same time managing all of these additional reporting and securities law overlays that come with being a public company. And so a lot of this, I think, because of these reporting obligations and this regulatory burden that comes with being a public company, a lot of the work of IPO readiness really focuses on building out processes and controls ahead of time that ensure that information kind of gets digested and flows up through the organization to management in an accurate and timely way. And sort of, I think the way we like to think of it is, that you're operating as a public company before you do the IPO, so that, you're not then scrambling once you've done an IPO to manage your business at the same time going through all of these new obligations that you're subject to.
Vika, can we turn it over to you to talk a little bit about these public company obligations? I think sometimes companies can be really surprised by all that goes into it and a little overwhelmed. So can you walk us through some of those considerations?
Of course. Now, hopefully, if you have done what Pete's just suggested and are already kind of operating as a public company, this won't be a complete shock and surprise, but undeniably will be. I think it's inescapable as a public company that you will be under much greater scrutiny. It increases profile, of course, which naturally leads to increased scrutiny more generally, but also you have the additional kind of constituents of your investor and analyst base who will be scrutinizing the company results, operations on a regular basis. And so effectively, this is an additional kind of constituency that you wouldn't have had as a private company, and that you need to kind of bear in mind when conducting operations, your expansion plans, your financing needs, etc. It's also undeniable, and I think an inevitable sort of part of being a public company, that the compliance burden is far greater. There will be more regulatory scrutiny and also greater scope in terms of the regulations that apply. And as a result of that, inevitably a greater risk of liability. So, your operations, your head office functions, the management of the company will be much more geared towards liability mitigation and compliance than would have been the case as a private company. And all of that, of course, then leads nicely on to the next point, which is increased costs. Inevitably, you will need greater support internally to satisfy the various different requirements, be they reporting, be they compliance, whatever it might be, as well as obviously the advisory fees that go along with that. So I think an increase in running costs is an inevitable part of being a public company. And also, I wouldn't underestimate the demands on management time. I think being a public company, having to go on, so roadshow after roadshow, meeting investors, meeting analysts, meeting the brokers, the kind of the role as management of a public company is often as much about the kind of public company architecture and the maintenance of that kind of infrastructure as it is the day-to-day operational side that would have been much more the focus as a private company. We've sort of touched on the next point in terms of the additional regulatory burden that applies to a public company in terms of both the additional suite of regulations that will apply specifically to a public company and just the enhanced scrutiny more generally. And so sometimes it will inevitably feel like the management of the company is almost being directed by kind of external forces and external requirements. And so there is a sort of slight sense of, a loss of autonomy, having to kind of conduct the business not only in compliance with all of the various regulations, but also more generally in the interests of stockholders, as opposed to kind of in that close-knit way that you would have been accustomed to as a private company, can be quite difficult for some management teams. Not all, and some are well aware and prepared for the change, But it is undeniably a change, and that can be quite difficult for some management teams to lose that autonomy, sense of control, and also the ability to be more nimble in moving with developments of the business, taking sort of advantage of opportunities that present themselves. Doing transactions as a listed entity is nowhere near as simple and straightforward as it would have been as a private entity because of additional kind of requirements, whether disclosure, whether shareholder approval, etc. And so you do kind of, you know, what you gain as a public company is significant, but it comes at a cost, and part of that cost is a loss in flexibility and to some extent control as well.
Yes, so echoing all of that, but diving a little bit into the corporate governance issues that will come with being a public company. So, for example, you may like the way you currently structure your board and who's on your board and how your committees are, you know, named and operate, and you know, you may have that down pat in a way that works for your company, but you will have to look at your listing rules and your local jurisdictional corporate law to figure out whether or not the way you operate and like to operate actually does comply, because there are some pretty, you know, there's a relative amount of flexibility, but there are some strict considerations about, you know, how many independent directors do you need? How many different types of committees do you need? What kind of experts do you need? And, you know, especially the current environment is that the proxy advisors, at least in the US market for, you know, ISS, Glass Lewis, have a lot of sway over all of this. And so in addition to what, you know, Vic is saying, like all these investors and attention, you also have these just kind of third party, almost quasi governmental entities who are going to be opining on everything that you do, whether you like it or not. And you're not even getting any money from them, which is almost the worst part of it all. So you really have to think about all of those external, you know, that external input on your corporate governance. You have to also think about the fact that all of this will be disclosed. You're disclosing your charters, your, you know, your bylaws. You're putting all of this in annual reports and quarterly reports, depending on your on where you're located. So that's a big change. Another thing to think about are just the general anti-takeover defenses. You know, IPO'd companies usually get a little bit of a pass in being able to implement some things to help give them a bit of cushion as they find their footing and become, you know, a more mature company. But those are typically taken away after you get that little bit of a grace period, and you're not going to really be able to rely on those anti-takeover defenses that you might have been more focused on as a private company. You can also think about there's been so much new rulemaking in the United States, at least for SEC. They've made it incredibly easy now for shareholders to nominate new directors and insert themselves that way. And so companies are just going to be kind of fighting on all fronts to maintain this control. And the last kind of consideration on the corporate governance front is the various accommodations that different markets might be able to provide. So for example, in NASDAQ, there are a number of different tiers with different types of different levels of compliance. And, you know, as you get to the more prestigious tiers, there are more compliance requirements. So it's a blessing and a curse. And then the last thing to consider is just also in the US, and I know that, you know, other jurisdictions are probably going to do something similar, but, you know, here you can have what's called a foreign private issuer status, and that can oftentimes be a little bit of a respite from the crazy requirements of the US laws, where you can kind of refer back and rely on the fact that you're complying with your home jurisdiction rules, and that will help you kind of comply with the US requirements while also not completely overhauling all that you do. So it's a lot to align, it's a lot to comply with, but there are ways to kind of make it easier on yourself if you are in fact a foreign issuer. So with that, I'll hand it over to Renaud.
Thanks a lot, Farrell. Any successful IPO is the product of the combined and coordinated efforts of the company and multiple external teams that typically spread over 6 to 12 months, including the IPO readiness phase. So the core working group will include several banks of various sizes, possibly an equity advisor advising the company, assisting the company in running the process and negotiating with the banks, one or more accounting firms, and at least one legal counsel for each of the issuer and banks. So it is critical to ensure not only that the various team members have the proper qualifications and expertise, which is attested by their track record, but also that they will have the bandwidth and are fully committed to the project, which may not be the case if they are separately busy on another large project. And also, all team members should have a cooperative rather than adversarial style, which adversarial style would inevitably create tensions and generate inefficiencies. Finally, I would say that the company should preferably should aim at selecting long-term partners or partners that have the desire and potential to work with the company beyond the IPO. The team members will all the more be committed to the project that they see it only as a step, be it an important step, in a broader long-term relationship. Farrell, I will let you chime in on this subject.
Thank you. Yeah, so the long term, I think that's like kind of the most important aspect of everything that you said there. It's when you're doing this, you're not looking for someone to just execute an IPO. You're looking for them to be your counsel going forward because they're going to know more about your business than anyone else. So I think that's a especially important consideration. So here you've got all the people that you need to do an IPO. So we're going to have people go through kind of each of these buckets and the considerations when you're picking these people and how they might, the things you want to think about and how they're going to help you. So Charles, can you talk a bit about the company personnel?
I will start with the company's internal team. Needless to say, doing an IPO will put quite a lot of pressure on the company's management because on one hand, business must go on as usual, but at the same time, significant time and effort would need to put to make the IPO project a success. So therefore, the company would preferably set up a team, normally headed by the CFO, which contains personnel of different departments, including legal, business, finance, and also the company secretarial team. Each one would be responsible with very clear-cut duties, and then to work closely with external advisor. Also, the senior management would need to evaluate the existing board structure because, as we previously mentioned, there are specific regulatory requirement and also corporate governance requirement for a listed company. So therefore, the board would need to expand to invite external independent directors to join. And at the same time, those independent directors, they must comply with the qualification and independence requirement. So, but no need to worry. The company's counsel and also the underwriters will help you with that.
Sure. So maybe I can chime in a little bit about the company's lawyers piece of that. So I'd say the company's counsel in an IPO plays an important role both in kind of guiding the overall process, but also in kind of shepherding the company through it. Recognizing that company's counsel has been through this process before, while this is probably the first time for a lot of folks on the management team. The company's counsel can help just kind of with expectations of what to look for in the process and guide the company through that. I mean, I think in terms of qualifications, putting aside the obvious things like having a strong understanding of the securities laws and the IPO process, one of the key things that maybe is sometimes overlooked is really finding just counsel that there's a good sense of fit with the management team. This notion of counsel as a long-term partner with a commitment to the company going beyond the IPO really can help the process in terms of just fostering open and really clear communication. And so I think in this regard, it really is very important to find counsel where the IPO is viewed as an initial step to a long-term relationship rather than just kind of the be-all and end-all of that. Really company's counsel in the process is tasked with representing the company's interests throughout the process. And so this manifests itself in ensuring that the company complies with applicable law and negotiating the agreements for the transactions. But it also shows up, I think, in some less obvious ways. So like, for example, ensuring that the company's voice is fully heard and reflected. As we've kind of discussed, this point is important because there's a lot of voices at the table when you're preparing for your IPO. And all of those voices, sometimes have very strong perspectives on your equity story. And while I think it's really important that you take all of these views into account, the company's IPO disclosure really is creating the map for its future disclosure. And so I think it's really critically important that the company looks back at the end of the process and feels that its perspective is the one that comes through in telling the story. And so I think the company's counsel plays an important role in making sure that the company's perspective kind of remains at the core of the process, even while taking into the account all the valid points that come from the other constituents. So maybe, Renaud, I can turn it over to you to maybe talk a little bit about the accounting firms.
Sure. Thank you, Pete. The accountants have a very important role also in any IPO and should be onboarded as early as possible in the process. They are not only responsible for auditing and certifying the company's historical statements, which is the obvious, but they also actively participate in the IPO due diligence sessions. And they are expected to identify and help addressing any sensitive accounting issues. Additionally, their contribution is key in responding to accounting questions raised by the relevant market authority, which are often substantial. And finally, the accountants or the company's auditors will need to deliver a comfort letter at the end of the process on all of the financial data, all of the numbers in the prospectus. So my experience of cross-border IPOs of biotech companies in particular is that some of the most complex issues whose resolution may materially impact the timeline often arise from the accounting side. For instance, one of our public company clients had to restate their historical annual accounts, notwithstanding their certification by a Big Four auditing firm, this prior to their dual listing on NASDAQ, and in anticipation of the approach that the SEC would likely take of deferred revenue accounting, which varies in the US from the prevailing interpretation in continental Europe. So this is to say, again, that accounting issues are not only technical, but often enough critical, particularly when dealing with cross-border IPOs in the biotech or pharma fields. And we can only urge any issuer with that profile to look into it as early as possible in the process. Vika?
So obviously the banks play a key role in any IPO, but I think what's sometimes less obvious is that they have multiple roles and wear multiple hats. So of course they kind of have an advisory role that's critical in terms of advising on the process, advising on the story, the messaging, the likely pool of investors, etc. But they also have a quasi, in some jurisdictions, and here I'm thinking particularly of the UK, they can have a quasi sort of regulatory role as well. So in some cases there are sort of strange mix of advisor, regulator, and kind of third party counterparty in terms of your dealings with them. They have in some markets an obligation independent of their advisory role to the company, but an obligation directly to the regulators to confirm compliance with certain provisions. In the UK, for instance, sponsors have, which would typically be the lead underwriter, have an obligation to deal with the regulator in an open and cooperative manner. And on the growth market in the UK, that's even more acute because effectively they are the ones who sign off on compliance with the applicable regulations. So they are obviously critical to the process, but do perform several roles simultaneously, which doesn't always make for an easy relationship. It's a critical relationship and crucial that the chemistry is right, the fit is right between the relevant bank and the management team, but it's sometimes a complex relationship to manage. As the IPO process sort of proceeds from preparation to execution, the banks will be the ones who coordinate the marketing process with investors, arrange the investor meetings, advise on the strategy in terms of dealing with the investors, and then ultimately build what will hopefully be a very successful book and also provide aftermarket support. And on an ongoing basis, the IPO banks will often be the ones who continue to have a relationship with the company, to the point that was made earlier about this not just being a kind of one-off short-term relationship, but all being well, it will be the IPO banks who provide ongoing guidance on likely investor sentiment for certain things, sometimes, you know, disclosure requirements, the respective kind of materiality of certain disclosures, etc. And so it will be a kind of a continued relationship and role that would often be expected to survive well past the IPO and its immediate aftermath.
And so with that, I mean, now that we've kind of gone over these high level considerations, what does the timing actually look like? So we have to highlight it first at the very bottom. It's highly variable, very facts and circumstances. But what you might, you know, a typical situation, you'll see that all of the jurisdictions are largely, you know, very similar. It's not going to differ too much based on what you choose in that regard. But, you know, the first bucket is going to be the planning. That's when you have your counsel. And they're going to help you figure out, okay, is this a company who's already operating public, like we discussed earlier, who may not have as much wood to chop, or is it someone who's kind of going to be, you know, starting off on this whole process, and there's going to be a lot of considerations and things to go through. So that initial, say, 6-month period, you know, you're basically planning ahead to figure out how you want to operate as a public company. And then in this kickoff meeting, you'll have an org meeting, and at that point, you'll have your banks fully onboarded. You'll all get together in the same physical or virtual room to start thinking about how you're going to present your story. The most successful IPOs I've been involved with there's one consistent thing where it's that the issuers at that point have a very good idea of how they want the process to go, how they want to present themselves, the various documents that they're going to enter into. And so that planning period that I talked about initially is really key to kind of strategize internally and with your counsel to make sure that you kind of roll out this very well thought out and you know, comprehensive plan for how you're going to operate. I feel like it really minimizes the back and forth that can sometimes distract from the process overall. And then the next, you know, middle bucket is the actual IPO process. This is where you're going to, and we're going to touch on this in just a second, but you know, you're going to actually submit a document to be reviewed by the regulatory body in whatever jurisdiction. You're going to have it reviewed. You're going to be, you know, publicizing the fact that you are going to be going public, but there are also a lot of considerations as you do that and rules you have to follow. And then lastly, the key time is the pricing. You know, you've done all this work and you finally get to, you've pounded the pavement to go to all the investors, and they've come up with a price that they're going to pay you for all their shares, and then closing is shortly after, and then you're public, you're off to the races. So just to touch base quickly on this regulatory registration review. So every jurisdiction is going to have this main document, you know, this either a listing document or registration statement, whatever you want to call it, has 3 different purposes. So first, the marketing, very key as we've discussed. The second is more of like a liability protection purpose. So you're going to have things in there, what we call risk factors. They're essentially warning any investor, whether it's a mom and pop or a very sophisticated, you know, sophisticated bank or other type of investor, saying, you know, every security is going to be inherently risky, and here are the things that are specifically risky for our company. So you definitely have to have that in every document. And then lastly, the regulatory purpose. So complying with, you know, for at least in the US, the SEC rules and every other, you know, jurisdiction's body that's going to be reviewing this. And so making sure you're compliant with all the rules, making sure you have the proper exhibits, making sure that the disclosure is accurate, and not misleading to investors. So obviously, whatever jurisdiction you're in, they're going to be taking a close look to make sure that it is compliant and proper. So with that, I'll pass it back to Charles to talk a little bit about diligence and all the fun that comes with that.
To control risk, certain due diligence would need to be conducted. So what is due diligence? Due diligence is basically a process that everyone would do some measures to understand the business and all the situation of the company. So that involves various forms, including physical visits, telephone conference, or physical meeting with the management, and then reviewing some legal documents. Of course, also includes some external checks like the litigation search. So the overriding purpose for doing due diligence is to ensure the listing document, the registration statement, the prospectus, the contents of which are complete and accurate. Also, by doing due diligence process, that will establish a defense to liability for any future risk. For example, if someone make an allegation on a company saying that certain information in the offering document is not correct, well, the due diligence process will be used as a means to defend the company. The whole process is a continuing process that would continue from kickoff until the completion of the IPO. And as I mentioned, the essential role of due diligence is to confirm the information, to address disclosing, and also the ensure that the disclosure in the offering document would be complete and not misleading.
Thanks, Charles. So, I mean, as kind of Farrell and Charles both touched on, there's this kind of recurring theme of complete and accurate disclosure. And one of the things that really feeds into this is the question of materiality. So one of the things that's required as you go through the IPO process is to disclose to investors all of the material information about the company that's going to be going public. And so it's important as we think about the disclosure for an IPO to understand what materiality entails. And in principle, it's very simple, right? The general idea is that, information's material if, when you look at the total mix of all the information that's provided, it's something that would influence a reasonable investor when they make their investment decision. In practice, of course, this is a much harder exercise. Typically it involves very complicated assessments of all of the facts and circumstances, and oftentimes is going to involve input from lots of different constituents. So often on hard materiality questions, it might involve input from the finance team, from the regulatory team, from the scientific team, like all of these perspectives coming together. And of course, one thing to keep in mind is that what's material differs a lot depending on the company, right? So what's material with respect to a preclinical biotech company is going to be very different than what's material for a global pharmaceutical company with billions of dollars in revenue. And so for an early stage life sciences company, I think this means that a substantial amount of time in the IPO process is going to be devoted to understanding and disclosing data. And I think there's probably going to be a bent, depending on how early in the process the company is, on really, if anything, over disclosing data, right? Because you're kind of in a better position if you've provided everything than being in a situation where perhaps you've left something out of the document and later people assert that it was important and should have been told to them. And so I think this also kind of ties back a little bit to the importance of the milestones and expectations that we talked about. So while generally there isn't kind of this legal obligation to disclose these forward-looking timelines, it's something that investors are going to expect and probably require for a successful IPO. So a lot of additional consideration will go into this question around disclosure of the timing of these milestones, the data inflection points, and then really, being 100% sure that you're going to be able to deliver on what you put in your document, because that, as we kind of mentioned earlier, is going to be very important to kind of the go forward credibility as you interact with investors on a go forward basis. And so, I mean, as we think about all of this, Vika, maybe one thing that I think is always a little bit not surprising, but maybe hard to manage is a company facing, a lot of restrictions on what they can say as they kind of work through this process.
Yeah, and this is critical, right? And in some respects counterintuitive, because on one level, in the run up to an IPO, the natural instincts of most companies would be to try and increase the profile and try and gen up as much kind of good publicity as possible. And unfortunately, as part of the process, we would, in pretty much every market, need to incorporate and implement very strict informational controls on what can and can't be said, which apply both to what can and can't be said sort of publicly in the press, as well as in more kind of ordinary course forums, conferences, discussions with, kind of third parties, those sorts of areas that maybe wouldn't kind of traditionally be viewed as kind of public communications per se. Most markets will require some sort of blackout period during the IPO process where communications are very, very strictly curtailed. But there's also a kind of a more sort of overarching point, which is really kind of part of the discussion that we were just having on the importance of the offering document itself being both accurate and, importantly, complete. What you can't have is a situation where something isn't kind of verifiable to the standard that it would need to be in order to include in your offering document, or is something that you wouldn't want to include from a liability perspective because it is, over-promising in some respects. You can't have a situation where that information is available to investors outside of the offering document, because then you leave yourself open both to investors having relied upon it and also allegations that your offering document may not be complete. And so you do need to ensure that any kind of communications to investors, which include both the more general communications as well as the specific presentations you make to investors as part of that marketing process, is consistent with your actual formal offering document or registration. And so to achieve all of this, you effectively have publicity guidelines, which is really the protocol put in place at the start of the process. And I just saw a question pop up on how far in advance you put those in place. Really, it's the first thing we do. So it's one of the first sort of items on the list when you start the IPO process, to get those publicity protocols in place. These would cover the do's and don'ts in terms of what can and can't be said. Also, how inquiries are dealt with. It's reasonable to assume that, inquiries will come in to all sorts of people within the company. Who's actually kind of allowed to speak on behalf of the company, and also what others should do if they get an inquiry, which generally will be kind of referring it to some nominated person, is part of those protocols that we put in place. So it is important that, even before the offering document's prepared, or you quite have clarity on how much you're going to disclose to investors, those kind of protocols are put in place so that you have kind of clarity that the various different communication restrictions that apply, which will vary by jurisdiction, will be adhered to.
And so sort of similar maybe to the communication question is one around, doing transactions during an IPO process. And one of, I think, the main questions we get when we're talking to a life sciences company about their IPO is this notion of doing a crossover investment, during the process or at the beginning of the process. And I'd say crossover investments by traditional public equity investors in kind of middle or late stage private life sciences companies increasingly has become a commonplace occurrence. So the graphic on the left side of the screen kind of highlights the reasons to do this. I think in addition to the sort of obvious access to capital that these investments can provide, they really serve an important function in the overall success of an IPO. In particular, I think they serve a validating function that signals to IPO investors that an important strategic investor has vetted the company's story and its valuation. And in this regard, I think having that kind of smart money behind the company really can be an important and sometimes a necessary IPO tailwind for a successful US IPO. On the right side, what we've highlighted are just some of the considerations and risks. What I'd say really to maybe sort of sum these all up into one is that this is a pretty well-worn path. So none of these considerations, I think, are really kind of prohibitive. But what maybe this is intended to highlight is just that because you're in a securities law regime, there's a lot of complexity and nuance. These are the type of transactions that just have to be carefully choreographed and done, really coordinated with your counsel, and so, once an IPO process kicks off, you really shouldn't be talking to investors about private rounds without first talking to your counsel about what guardrails need to be put in place to keep it from running afoul of any issues. And then, I think to maybe kind of wrap things up, I think, Vika covered a lot of these when she was going through the considerations earlier of when you're thinking about doing an IPO, highlighting kind of an IPO is a major milestone for a company, but it's also really important just to keep in mind, even at the beginning of the planning process, right, that we're, just at the beginning, and really the IPO, while a huge transaction, it's really just the start of a public company life. And so you both want to understand what you're getting into if you pursue the path, and that preparation that we talked about really can help you emerge from an IPO really seamlessly. And so kind of brings things full circle to the importance of the early stage preparation, because that really is what's going to carry you on as a public company. And so with that, I do think we're pretty much out of time, but I want to, on behalf of all the panelists, thank everyone for joining us today. Obviously our contact information's out there, and you can certainly feel free to follow up with anybody that was on the call today. And thanks so much for joining.